Hey, hi there. So, in today's video, we'll be looking at a very interesting topic of direct versus regular mutual funds. So, I'll begin with a very short story about mutual funds. Mutual funds before 2014 used to be only in one singular mode. There were no multiple different options for a singular mutual fund to choose from. So, for example, you see the topic of this mutual fund is about choosing between direct and regular mutual fund. But before 2014, there was no such option itself which was available, so it was pretty easy for people to just choose a mutual fund and go and pay whatever commissions etc to these brokers, and there was no other options out there. But then it turned out to the amphi, the mutual fund organization, that there are people who are educated enough to choose their own mutual funds, and they may not want to pay out or shell off extra commissions to these mutual funds. And how do that get charged from you? I'll just talk about that shortly. And that is when on 1st of January 2014 they had introduced this concept of direct mutual funds. So before 1st of January 2014, it used to be like there was a AMC, there was this broker, and there it was you. So you had no direct way to buy from a AMC or a asset management company. And when I say asset management company, it could be anything like a HDFC mutual fund or a Tata mutual fund. And these names are just for representative purposes, nothing to do with any recommendation at all as such. So there was no other way, as I just mentioned, for you to choose any of these direct mutual fund schemes. You only had a regular mutual fund which you chose, and you were paying your broker all the way throughout the process. But what changes happened in 2014? In 2014, the AMFI said that the broker is not a mandatory route. You can actually directly go ahead and take a direct mutual fund from your asset management company, from your HDFC mutual fund or a Tata mutual fund or a Quant mutual fund or whatever, right? And this actually gave the more educated investors a freedom to not pay to this broker in between, right? So this was all happy, right? Everyone should have moved, who could and who wanted to, should have moved to the direct mutual fund over these last 10 years. So it's more than 10 and a half years that it has been there, the direct mutual fund being there instead of regular ones. But the sad part is that people are still continuing with their old regular SIP plans, and not because they don't want to switch, but because they are unable to switch. Why are they unable to switch? If we were to talk about why are people not able to switch from direct to from regular to direct, right? So they first of all don't know how to. Maybe that, and I'll talk about all of those aspects. How can you switch from a regular to direct mutual fund very shortly? And a few other reasons why people were not able to, people not able to go from your regular to, let us say, direct, right? So one is they have you may have your broker portal, where your broker has not given you an option to actually stop your SIPs in your current mutual fund or switch your SIPs from your existing scheme to a new scheme. And when I talk about switching, I'll talk exactly what it means and how it happens. All right. I also talked about something called as TER, what is known as the total expense ratio, which actually defines how your agents are getting paid. So if you thought your agents were getting some money from some other agency and it was not shelling out from your pocket, yeah, that is a myth. You are paying for all your agents that you book your SIPs through, and that is not a small sum. Over for something like a SIP of 1 lakh over 5 years, you would be paying at least 5 lakhs to your broker. And for instance, for example, I have taken one simple mutual fund, nothing of a recommendation here, but yeah, something I was just researching about. So Tata Digital India mutual fund, same fund, growth option, but one is, the changes only here, this is regular and this is direct. So you can clearly see this is a screenshot from today for both of these mutual funds. NAVs are different, all right, and dates obviously are same, plans are same, only difference is direct, and this is there is no option. So they stopped saying that it is a regular, but it is a regular. So as you can see, right, this is a regular, but just as a nomenclature to protect their brokers, the mutual fund companies typically don't take that name in their mutual funds nowadays. Uh, yeah, sad but true. Let's look at few other matrices for the same regular versus direct plan. You see the 1 year returns for both of these mutual funds 30.72 versus 32.5%. There is a difference of almost 1.36%, right? Where does this come from? I'll shortly talk about it. If we were to look at historical returns for both of these options, again the same mutual fund, same regular versus direct plans I'm talking about, weekly, monthly, quarterly, bi-yearly, year till date, for 1 year return, since inception returns. Let's look at just the since inception annualized returns. So if you were to look at since inception annualized returns, 18.29% versus 20.25%, almost a stark difference of 2%, right? Why? Because you chose to just book it through your broker. Now, just look at how it would have looked like for a SIP. So you can look at the numbers, but just to summarize, if you were doing a 1 lakh rupees SIP for 5 years, you would have made so much money in regular, so much money in direct. And what this difference comes out to be is that money, if that number, if you look at 10676,567, 10676,567 minus your 101,78298, 101,78298, the difference comes to 4,98,269 rupees. And this is for a specific mutual fund for a 1 lakh rupee SIP over the last 5 years. Whom have you given this money to? You have given this money to your broker for just suggesting you, or not even suggesting you, for just booking that mutual fund on your behalf, for doing that SIP on your behalf. All right. So it's your choice whether you want to actually give that money to this guy or not. I leave it to you. But to specifically look at where this money can be looked at in terms of matrices in your mutual fund, if you go to a spec sheet of your mutual fund, or to the scheme details on, again, any website. This is from I think Money Control, right? So again, details of the same mutual fund. It's the same fund manager. Its launch date is same. Everything else is same. What is the difference? Is the expense ratio. There is a difference of this 1.36%, the same 1.36% that I talked about earlier, right? This is the difference between your regular plan and your direct plan, which you end up paying 5 lakh rupees over a period of 5 years for a 1 lakh rupee SIP. All right. Over 20 years, this could be onwards of 30 lakhs, 40 lakhs as well. And for a similar chunk of SIP, I'm talking about 1 lakh SIP, I'm talking about. So, are you willing to pay that amount to your broker for the services that they offer? If they are offering some services, maybe yes. If not, maybe no, right? But again, coming back to the same question, why are people, if this is such a big difference, if you are shelling out so much of money, now let us say today you understood that you are paying so much of money to your broker and you don't want to continue with him. All the brokers over here, if you are watching the video, please, sorry to take out your revenue share, but I wanted to just inform everyone about how this is done and how someone can actually switch who wants to, who doesn't want to pay you, the Mr. Broker. All right. So how does it happen? So the main problem is you have booked through these mutual fund brokers. You don't really know how to change it, how to stop your. So first option would be to stop your SIPs, because first thing you will do is stop your SIPs. Second thing you'll do is switch your mutual fund from the same mutual fund regular scheme to same mutual fund direct scheme, which takes all your funds, all your NAVs. So basically, you sell all of this, and on the same day, you buy. And if you want to wait for the proceeds of this one, maybe you'll have to wait for 2 or 3 days, wait for the proceeds to get credited to your account, and then using the same money, buy again your direct mutual fund units from the same mutual fund broker or the same mutual fund scheme. right? And also, what you need to do is stop your SIPs into the existing regular mutual fund, right? Into the regular mutual fund, right? And then you are good to go actually. But problem is, you these brokers have not given you an option to actually either stop or switch or both, right? And that is why you're not able to. But it is pretty simple for you to do that. You may not have logged into your mutual fund broker ever, but what you have is your folio number. Just use your folio number, your PAN details. You should be able to log into your mutual fund broker, website. Every mutual fund broker and you're not buying from a broker, or rather, you're not buying a broker's asset. You are buying the asset of a mutual fund company. So your actual folio exists in their records. So you are their direct customer. You're not the direct customer of the broker. The broker is just a broker, as the name is called, right? Intermediary. So but you can directly log into their website, actually look at your folio. And if it were I were to tell you the most simplest thing to do to stop your SIPs would have happened through one of the routes, is electronic clearing system, through a check that you would have given to your broker for each of the mutual fund SIPs, which would have kind of ECS mandate, which would have gone into your bank. You can actually delete that ECS mandate from your bank. And this option obviously will not be available in your bank's mobile website. So be aware of that. Don't, if you're too mobile savvy, and don't ever log into your web portal. You'll have to for this particular task. And I'll take an example of ICICI Bank in today's example, but it more or less holds true for any other bank in the planet, in India at least. And I'm not. Planet is even worse. If you go to the US, they have more paper-based processes than India. Howsoever, they may be developed, and we are still developing. So, okay, not talking about that aspect right now in this video, but yeah. So coming to how you delete your this thing, right? Again, some few more details. Again, the screenshots I've taken from one of the videos of LLAs, labor law advisor, right? Yeah, a couple of data points. What is this total expense ratio? What we had just seen to be like 1.67% and 0.31% here. So mutual fund AMFI, the regulatory authority, has given that equity mutual fund cannot charge anything more than 2.5%, and a debt mutual fund cannot charge a total expense ratio of more than 2.25%. What does this expense ratio typically entail? It entails your manager's fee, which you cannot avoid, which you'll have to pay. Fund manager's fees is basically for all the people who are employed by, let us say, HDFC mutual fund or a Tata mutual fund. So that it has to be paid out by the mutual fund company. Then your distributor's commission. So the broker basically, right? You can get rid of this part, and few other advertising expenses, blah blah blah. So that is exactly your expense ratio, which gets cut from your like daily NAV. So if your expense ratio is what 2%, then it gets deducted like by divided by 365, and every day it gets kind of deducted from your NAV value. Now coming to how would you stop that ECS? Yeah, how to stop ECS online in your bank. So you want to stop your SIP, right? And you don't know any other way to do that. Simplest way, go to your bank and stop that ECS, that check mandate that you had given to your broker, right? Once you stop that, they cannot charge you. They'll just get deleted from your bank's records, and they cannot charge you any more SIPs. And you can do a fresh SIP in your choice of platform. And what choice of platforms you can choose, I'll just shortly talk about that as well. So this is typical ICICI Bank. You go to your service request within the customer service on the right over here, the services request. This again is taken from some YouTube video, so thanks to them. Yeah, so these two options, you go to your bank accounts, ECS and ACH mandate cancellation on the bottom. You select your account number, you go to your account number. Once you go there, you are able to see all these mandate lists. You choose whichever you want to choose, you submit to the button, And just a thing to mention, notice over here, don't do this for fun. Once you delete it, you will never be able to activate it back again. So if it is a existing mutual fund that you want to continue and don't want to actually remove from your records, please don't play around with these options. This would actually remove your SIP from your account. It will never get deducted again unless you do it fresh. All right. So this is just to show how you would remove this. Just to also talk about how much frustrated people are, right? This is someone who had commented on that particular video itself, who had talked about these screenshots for how to remove ECS. So this Mr. Rajiv had purchased some SIPs through ICICI Bank CRM, and he wanted to switch it out. He talked to everybody, they talked to HDFC Bank Demat account people. He talked to HDFC Bank people, securities people, ICICI Prudential people, ICICI Bank branch people, but all of them raised their hands, right? And eventually, using this, what I just explained to you, he was able to delete this. So it is something which is helpful. So that was how you remove your ECS. But how do you actually now switch? The biggest problem is now how do you switch? So there are many options out there for mutual fund aggregator platforms. What these mutual fund aggregator platforms do is take out all your mutual funds that are existing in your records. All of them are linked to your PAN number. It is very easy to fetch them online. There is a process which is available with each of these mutual fund aggregators as well. I'll shortly walk you through one of those processes with Kuvera as well, which is one what I personally use. No recommendation, nothing of that sort. But yeah, that is something very easy to kind of leverage. So what I would say is maybe I'll move myself to the right. Choose any of these above mutual funds actually, and each of these aggregators is what I mean. And you'll be able to bring all your holdings to one platform, and this is where you can play anything with your money. So only intent is that you should have the control of your money, not your broker, and you should get the best return out of your money that you're investing, not your broker. Why should you be paying lakhs and lakhs of brokerage to a person who just was helpful for you to for signing a form? Those days are gone. So some prerequisites: your KYC must be updated. If it is not, please go ahead and do that in one of the Carvi or CDSL places, right? So these are few people who are I may be wrong about the second option, but Carvi is one for sure. And you would know who is your KYC authority. I guess it is CDSL, the other one, but yeah, I can validate that later. So why you have to do it physically? There are online KYC options available, but there are limitations to it. Some 50,000, 1 lakh rupee limit of per year transactions that can happen. So you don't want to get limited by that. So go to a physical center of one of these Carvis or CDSL, whichever is linked to your particular mutual fund. Um, all your folios are linked through that KYC to your email and mobile number. So you should have the same email and mobile number across all your mutual fund. If you don't, just ensure that you update your KYC records. Your address also should be updated over there, and yeah, even your bank account details should be same across all the mutual funds. And obviously, you should have some self-imposed discipline, right? This is the key, because to keep the compounding happening, you should stay invested in the market. Having this control is all about keeping the control with yourself, so that you know where your money is going, and you can increase, decrease, or change or switch whenever you want to. You don't need to give this control to a third party, a broker, a person who just helped you to sign that first check. So how do you do this on the platform like Kuvera? These are a few screenshots. So in Kuvera, you have this option called import portfolio. You can click on mutual funds, and it will give you few options to key in your email ID, and you'll be able to generate a statement of all your mutual funds through uh, you know the government linked mutual fund website. You'll get an email with a password protected sheet which has all the details of your mutual funds. You just import it here, and all of those mutual funds would get reflected in Kuvera. This is again one of the screenshots of one of the specific mutual funds within Kuvera. This guy has some 70,000 rupees in HDFC small cap direct plan. So this is a direct one. If it is a regular one, you'll actually be switching to something else. And if you click on switching, what you'll get is a screen like this, where you'll have an option to switch from and switch to. Once you click on switch to, you'll have all these options. And one beautiful thing about Kuvera is you won't see any regular plans here. All are direct. Even by mistake, you won't be able to go for a regular plan. So right, so when basically switching, just keep the following things in mind. One is that capital gains will be there for whatever you switch, right? So capital gains tax, obviously, LTCG or STCG as they call it, long term as well as short term can get charged based on the duration you have kept your mutual fund. Best practices for any mutual fund is which is more than an year old. Switch all of those, because anyways you have to pay that long term capital gain of 10% on it at some point in time in the future as well. So you can pay it now. 1 lakh of the capital gain, anyways, you can set off every year. So that is a gain, so what that means is basically it is called as tax harvesting. There's an option for that in Kuvera as well. You can learn more about it, or I can do a video later. In case you want to, let me know in the comments if you want a video on tax harvesting. So tax harvesting basically lets you save this 1 lakh of tax, long-term capital gain tax every year. So for 30 years, let us say you keep on doing this, you'll be able to save taxes on 30 lakh rupees of 10%, which comes to somewhere around 3 lakh rupees. So yeah, that was all I think for today's video. Thanks for watching.